So, you want to know how to select a good stock? Well, congratulations, because you came at the right channel. So today I'm going to be talking about my top 5 criteria before buying a particular stock. So generally people will be giving all kinds of generic answers like whether the company is having a great balance sheet, or whether are they having a good financial statement or cash flow, or whether do they have a good brand reputation. But in this video, I'm going to be specifically selecting 5 criteria, which is also part of my strategy on how I look in stock, and that is whether is it worth to buy or not. So let's get into it. Number 1, it is the profitability of the particular company. So I research whether the company have a very consistent growth in terms of their profit margin. I will look at the past 5 years in how have they been doing. So usually I will look at stocks that are consistently growing at a positive uptrend, and I will always see, are they constantly improving their sales volume? Do they manage to cover all of their costs and expenses, or are they getting profit despite having a very high operational cost? But then again, the company's net profit should not be used the only determinant to determine the movement of the share price. Other factors also must be taken into account when evaluating a stock. Like for example, you can see that in the case of the Kuala Lumpur Kepong, which is a plantation company, the symbol is called KLK. So despite its company's net profit had shot up to 25.9%, but you can see that their share price is still falling. Why? Because their sales are actually underperforming, and the demand for their particular product and services are actually deteriorating. So this indicates that profitability shouldn't be the only indicator to determine whether is the stock worth purchasing or not. Now we come to criteria number 2, which is whether is the stock undervalued. Usually how I evaluate a stock is I look at their PE ratio, which is the price per earning ratio. It is used to determine if the stock price is valued properly relative to its earning. So a very desirable PE ratio is going to be at less than 17. And also I will look at their current dividend yield, whether is it higher than the average dividend yield for the 5 years. So generally a dividend yield of 5% or more is considered undervalued stock. And besides that, I also look at whether is their earnings per share is higher than their dividend rate. So if you don't know what is EPS or earnings per share, it basically means that a company, whether is the company profitable enough to pay out more money to its shareholders. So for example, a company might increase its dividend as their earnings increase over time. So generally how you want to see earnings per share is that if the earnings per share has more than 85 ratings, it is actually considered as a market leader. And the third criteria that I will look at is that whether do they have a very high investment or not. So for example, do they use their profit to reinvest in their business? Do they have an acquisition of plant or machine, anything that can reduce the production cost in the company and improve their overall production? So, but before getting into investment, it is very important to know whether that the company is able to pay off their debts, which is either their short-term or long-term obligation. It is also called current ratio. So in theory, desirable current ratio should be at 2 against 1. What does it mean by that? Basically, it means that every 1 ringgit of current debt, the company will have 2 ringgit to pay off the debt. That is basically what it means by 2 against 1 current ratio. But realistically, if the company has more than enough to cover its liability, it's already considered as a good company. Another criteria that I look at is do the company have a low debt rate? So the low debt rate usually can be found in the debt ratio. Basically what it means by debt ratio is that the formula is the total debt over the total assets. So it depends on the industry to determine if the company is in a good or better financial situation. So for example, a debt ratio of 30% may be too high for an industry with volatile cash flow, in which most businesses take on little debt. But generally, if you are investing in a blue chip or big company, you would find that the companies usually they possess a debt ratio of 70% or lesser. What debt you're actually looking at? Basically, you have to look at companies that use those debt for a good use. Basically, it's called a good debt. So what does it mean by a good debt? So basically, it is a debt that is used to invest in assets instead of investing in liabilities. So what do we mean by investing in liabilities? So basically, it's like applying short-term loan to pay off long-term loans. So basically, it's anything that doesn't help the company to expand their business. So if you discover that the companies does this, like for example, they apply short-term loan to finance their long-term loan, then I would suggest you to avoid investing in those kind of company. And last but not least, are they futuristic, and do they have a good management team, and whether do they stand out from their competitors? So companies that have a strong and great visionary and strategic plans for the future, they are companies that you want to look at. But all of this could be rather a subjective statement to predict a company's growth, because not 100% of the time the company will fulfill its promises or meet their marketing goals. So for example, what if the company had set really very unrealistic sales target in a way to hype up and bring confidence to the investors? However, they failed to reach those targets. And also you can see that what if the company tends to overpromise and under-deliver? So for example, you can see in this case is that, you know, Elon Musk, which is the founder of Tesla, he's actually very confident that the company can produce 5,000 Model 3 of electric cars per week. However, the latest news shows that he failed to do so because the production pipeline has been plagued with problems which hinder the output. So the numbers were actually as low as he's only capable of producing 830 cars per week. So you see the huge difference. And also another thing to consider is that what if their goals are being delayed, or in the worst case scenario, they have been terminated. So in this case, you can see that it's one of the stocks that I've actually invested, which is AirAsia. So they have actually failed to secure a deal with China to tap on the largest Chinese market. So oftentimes it is very difficult to predict how good a company is, but there are ways to determine it. Some of the ways are you can check the company's background profile, whether the company is recession proof or not. What does it mean by recession proof? Meaning that the company managed to survive despite having an economic downturn. Or also you can see whether does the company have a good reputation in solving problems in the nick of time, or maybe even research on their awards and achievement that are given to the company. All in all, it is the execution that matters. So rather than just having plain words, just trying to convince that their company is worth investing, it is better if you see their action or results, because there's a saying called action will always speak louder than words. So those are the 5 criteria that I will look at before purchasing a stock. I hope that you find this informative and insightful, and if you enjoyed this video, please do hit the thumbs up and maybe even share this to your friends. And maybe even comment down below, because I do love to read your comments, and maybe even give some feedback on what you think of this video that I've done so far. And yeah, like, share, subscribe, and I'll see you guys on the next one.